Good evening, everyone. Sorry, I'm a couple of minutes late. I had some technical issues. Um, Before I start, can I just ask if in Q&A, if anyone can let me know that you can see the PowerPoint slide okay? Maybe just if you can say yes or something for me, that would be awesome to make sure that you can see what I'm going to be talking about. Cool. Thank you for that. Um, what I'm going to do is what I'm talking about today is quite heavy, and I'm sorry about that, but it is heavy for a reason because there's a lot of stuff in here, and the way I've designed the webinar is I've just put a lot of content in here, and the content's not going to suit everyone, but the idea behind it is you pick the bones out of the content that applies to your personal situation. So what I did was, rather than run a generic webinar for all our businesses, I decided that the best option was to put together a content heavy presentation and then have a one-on-one consultation with each of our business owners so I could apply the rules to their personalized situation, because everyone's situation is going to be totally different. No situation is going to be the same. So some of the slides I'm just going to bring up and not speak about because it's not necessarily needed, but you can have a look at it later. For those of you who don't know who we are, we're a practical and proactive accountant whose mindset is to get the best result for the businesses we work with by fully utilising the rules. We only work with a maximum of 50 businesses at a time to ensure you still get a personalised service. And just to let you know, at this point in time, we only have 4 spaces currently available. We do work with a lot of dental businesses, but we don't just work with dentists. And we are recommended by Jesse Green to all his clientele that he's coaching. And the last thing before I get started, if you want a copy of the PowerPoint slides, please send me an email to the email address that's on the last slide, which we'll get to eventually. And that way I'll happily send you out a copy of the full PowerPoint presentation, because there's a lot of information in here. And that way you can look at it at your leisure. And I will go quite quickly because there's a lot of stuff to cover. And I'll cover the things I think you need to cover without being too heavy, as light as I can. But there's a lot of information in here. So as the slides state, by the way, if you've got any questions or anything, please type in the Q&A and I'll do my best to get to them at the earliest chance I get, okay? So, as you saw from the first slide, this is about the personal service income rules and personal service business rules, which have recently changed, and I'll go through who it impacts, but it impacts all dentists, 100%, and it impacts a lot of businesses that are service-based businesses. So therefore, these rules you do need to be aware of, and you need to think about these rules in light of your own personal business and personal setup to make sure you apply them appropriately and make sure you're ticking the boxes on these, because I believe these will be an audit point moving forward from the ATO. I think these are going to be on the radar, so you want to make sure you dot your I's and cross your T's. So in summary, the first 3, you've got to go through the first 3 steps and ask the 3 questions, and depending on the answers, depending on the impact. So the first thing is, am I running a personal service business? Well, the answer is going to be yes, because I'm not even going to go into that with you guys. The reality is you see a heap of different clients, and therefore you are running personal service businesses. So step 2, if you're running a personal service business, the next question is your business income actually generated from your business structure or from your person? Now, 2 questions you need to ask yourself is, does your business, have as many non-principal practitioners as principal practitioners? Now, what that means is, if you're the main equity holder in your business or the owner of your business and you're clearly a principal income generator, what it means is you need to have at least as many principal income generators that aren't equity owners also in your business. So e.g., minimum would be, if it's your business, you need to have at least one other principal dentist or principal income generator, And the second element they look at is more than 50% of the fees derived by not you as the equity holder or the primary equity holder. So what that's really ascertaining is my business income generated from my structure or not? Now, a simple way to look at it is, if you got hit by a bus tomorrow, can your business still function and generate an income? And if the answer is yes, then you're generating your income from your business structure rather than your person. And those two questions are in line with that. So if you're not generating your income from your business structure, what you are able to do is run your business through your choice of structure, whether that be sole trader, trust, partnership, company, whatever it ends up being, and put all your income in there, claim everything you're legally entitled to claim, but anything left over, generally speaking, has to be given to you. It can't be income split, or it has to be given to the other equity holder or holders. Now, if you are generating your income from your business structure, then this is where the rules come in, because in the past, what has happened is, what you're allowed to do is if you pass the business structure test, then you're able to just income split the profits, and no dramas, no additional consequences, no additional rules. But that's now changed. So if you're able to income split, then you now have to abide by the new rules, which I'm going to cover. And step 3 is, if you are generating your income from your business structure and you can potentially split your income, then you've got to meet one of the following tests. And I'm going to cover these, obviously. The arm's length remuneration test, the 50% share of profit test, or the 30% effective tax rate test. So I'm not going to go through this because this is not appropriate for you guys. This is for people who potentially don't meet the personal service business rules. So I'm going to skip over that. In a nutshell, if you, just so you guys know, in case it affects other family members or anyone you know or friends, if you sell something, so if you sell stock, like you sell windows or you sell clothes or whatever, these rules are not affecting you because it's not personal service income, it's sales of goods. And the other thing is that these rules don't apply if your income is generated mainly by the supply and use of big assets like a bulldozer or a truck. In that instance, it's not deemed personal service income. So I've already covered all this sort of stuff in a nutshell, but that way you'll see a bit more detail, how that's all broken up with the personal service income rules. I won't go into that now. Now, what happened was, there was a thing brought out in 2015, which got suspended in 17, which was basically covering how you're meant to allocate your profits if you're a professional business. Now, God love the ATO. They suspended the rules in 17 and no one knew, we weren't 100% sure what we were meant to be applying, what guidelines we were meant to be applying. So what we ended up going back to is what I said at the start, is if you pass the business structure test, which is what the old rules were before these guidelines, then you could income split. Now, these guidelines, professional service guidelines, can apply to the 30th of June, all the way up to 30 June 22. And there's 2 guidelines I'm going to be discussing. One is the allocation of profits firms guidelines, which is what I'm going to cover now. And then up the third line, it talks about a practical compliance guidelines, or PCG, allocation of professional firms. That's the new rules that came out in December 21. Now, just so that you know, technically speaking, those new rules, the PCG, applies from 1 July 22, which is, in other words, in this financial year we're in now. But if you're worse off by the new rules, you can apply these guidelines, the ones that were suspended in December 17, for the 22, 23 and 24 financial years, and the new guidelines will only come into play from 1 July 24, which is the 25 financial year. Now, the majority of people, just to summarise to you guys, the majority of people will be worse off under these PCG guidelines. So therefore, most people, majority of people I'm having conversations with, will be applying the suspended guidelines until the 30th of June 24, and then they'll be applying the new guidelines after that. So I've already spoken about that. I won't go into that. Now, remember I said there was 3 tests: appropriate remuneration, 50% entitlement, and 30% effective tax rate. This is under the suspended guidelines. So this is what we're going to be applying for the next 3 years, 22, 23 and 24 financial years. Benchmark 1, and you only have to pass one of these, is you have to get appropriate remuneration. Now, where it gets a bit tricky is what's mentioned in the rules is, as you can see from the 3rd paragraph, it talks about you've got to receive remuneration that will be the equivalent of the highest paid employee would get in the upper quartile of employees. Now, that's pretty complex. What it really means is you need to earn at the top 25% basically of what someone would get equivalent to the role you've got without being equity. So in other words, the type of role, the relationships, the knowledge, the dealing with clients, all that sort of stuff without the equity bit, you need to be in the top 25% or the equivalent of the top 25% of what they would get. Now, for dentists, obviously you guys know this, that would be somewhere between 30 and 40% of the gross fees that they generate or see each year. And the rules depend then, obviously, the 30% would be the low end, 40% would be the high end, and it's usually somewhere between 35 to 40% depending on the fee. What a lot of the guys we work with is it depends on the amount of fees that are generated by each dentist as to what percentage they end up getting, but usually somewhere between 35 or 40%. There'd be a reasonable argument, I reckon, that if you're getting the 35 to 40% range remuneration, that there'd be a pretty good argument you would pass benchmark 1. Benchmark 2 means that 50% or more of the income from your business to which you and your associates and associated companies or trusts is accessible in the hands of you, the primary equity holder. Now that would be a hard one to meet. You know, where you're making good money, which obviously a lot of dentists do, this one will be a hard one to meet because it'd be rare that 50% ends up in your hands of the profit. Not impossible, but rare. The last one is the effective tax rate for you, for which the income to which you, as the primary equity holder, is entitled, plus to which you and your associated, people like wives, kids, other trusts, other associated entities are all collectively entitled. You must have an effective tax rate of 30% or higher for both you, for what you personally receive as the equity person, and also to the associated entities and associated people who are also get money from your business. They have to be paying an effective tax rate of 30% as well. Now, that tax rate ignores Medicare levy and Medicare levy surcharge. It's basically the gross tax. So you've just got to pass one of those 3 tests. My personal opinion is, out of all the client businesses we're speaking to one-on-one, there's not many who can't pass one of these tests, which therefore is for the next 3 years. And therefore the income splitting is on the cards. That's just an example, which I'll leave up there, which I won't go through, so you guys can have a look at it later. Now, the other thing you need to know, for you guys that have service entities, just to let you know, the income that is generated, or the profit, the profit that is generated from the service trust or service entity, I should say, that profit is also part of the overall income split. So in other words, that's deemed income split as well. So you have to put it all together and either pass the 3 tests of appropriate remuneration, 50% profit, or 30% average tax rate. So the service service profit is also included. Okay, and there's an example in here which I won't go through. And there's also examples, which is way too complex, of how the effective tax rate is worked out. Now, what I've just gone through is the guidelines has got suspended. Remember I said not that long ago that if you're going to be worse off under the PCG, then you can use the suspended guidelines for 3 years, for 22, 23 and 24 financial years, which the majority of people will be doing. But after 30 June 24, I'm going to take you through this just so you got some idea what's coming. But I will say this, and I've said this to every person I speak to, don't panic because it's 3 years away and so much can change legislation-wise in that time. My suggestion to everyone I'm speaking to is these new rules apply from 1 July 24, so in other words for the 25 financial year. So my suggestion is when I'm doing tax planning with my businesses, around April, May in 24 financial year, at that point in time, we will assess whether these new rules are coming in under the PCG or whether they've been watered down or changed. And then we will apply those new rules or discuss those new rules when we do tax planning consultations with each of our businesses one-on-one around April, May 24 to see the impact that it may have on the 25 financial year. So therefore, don't panic, but I want you to get an eye on what's coming. And as I said, the rules apply from 1 July 22. Now, just to put in perspective, professional firms under the PCG includes anyone who provides knowledge-based services, including, but not limited to, accountants, architects, engineers, financial planners, lawyers, anyone in the medical field, management consulting, obviously dentists, literally anyone that has a brain-based occupation where they do a lot of uni work to get there, degrees and postgrads and all that sort of stuff, will be caught in this. Okay, there won't be an exception to that other than the ones I've already mentioned previously about if you sell trading stock or if your primary income is really linked to big equipment and things. So I'll keep going through this. Now, don't worry about this. This doesn't matter. Now, okay, this is the risk assessment framework that we're going to be covered by from 1 July 2024. Now, I'll go forward. Just have a quick look at that. You can see there's 3 risk assessment factors, and you'll see that they're very similar to what was in the rules, the suspended guidelines. The first one is proportion of profit entitlement for the whole business returned in the hands of you, the primary equity person. The total effective tax rate for the income you get for you and your associated entities and people, and the remuneration returns in your personal hands. There's 3 levels and there's a score ranking of 1 to 6. Now, I'll come back to that in a second. I'll flick over. These are the risk zones. Low risk, before I get into that, there's 2 table factors. One is an aggregate score against the first 2 factors, which is the proportion of profit returned in your hands and the effective tax rate. And the last one is all 3, which is the proportion of profit, effective tax rate, and the remuneration returned in your personal hands. Now, the advice I've been given at the moment, and remember these rules are 3 years away for those people who are worse off by them, is the 3rd risk assessment factor, which is about appropriate remuneration in your hands, is very difficult to accurately determine. So for the purposes of this conversation, I'm going to ignore the 3rd factor and only focus my concentration on the mid-table, which is the first 2 factors. So to be deemed to be a low risk of an audit, you've got to be less than or equal to 7. A moderate risk, 8, or a high risk, you've got to be 9 or above. Now, I'm hoping that closer to the time, if these rules actually do come into play, that there'll be a bit more clarity on the 3rd factor, but I'll ignore it for now. So what that means is, if we're focusing on the first 2 tables, and remember, we need to get it 8 or less, right? Because if you're 9 or above, you're at high risk. To get 8 or above, you've got to literally get 2 4s, or a 5 and a 3, or a 3 and a 5, or something like that. I'm going to say 2 4s. So what that means is the proportion of profit that you get in your hands has to be between 50 to 60%, and the total effective tax rate for income you receive and all associated people and entities has to be between 25 to 30% to get an 8, which means you're only then deemed a moderate risk. Now, as you can probably gauge, right now we only have to get one of these. If we have to get, say, 2 4s, I would argue the majority of you guys are going to be worse off under the new rules and be paying more tax, and in some cases a lot more tax. Don't panic. As I said, I'm not sure these rules are going to actually come in the format they are, but I wanted you guys to know what you need to do now, 22, 23, 24 financial years, and what you need to focus on, and then have an eye on the future, knowing that these rules are potentially coming, but let's not overthink it at the moment until they actually come into play. And whether they come into play in this format, I reckon the big accounting firms and the big legal firms and all the associations will probably lobby pretty hard with the ATO, that I'm hoping that we'll end up with this. The suspended guidelines is what we end up with, or you get to choose which is more appropriate. But I thought you needed to know whether in 3 years' time what the rules are going to be. So, but I think there'll be a lot of people paying more tax. So, what I'm going to do, I'm going to skip over that. I'll leave that up for a second. Skip over that. I want to go through some examples of how these rules are going to apply. I think this is really important. So this, remember, is the PCG. But the concept of how you work out, like remember that out of the 3 tests, one was appropriate remuneration, one was 50% profit, and the other one was 30% effective tax rate. It's similar concepts in here. I'm not going to focus on the third one because these examples or case studies are purely to do with the PCG, which isn't in play, but the concepts are the same that we have to apply now in items 1 and 2. So I'm going to focus on items 1 and 2. So in this example, the business is run through a company, so a trading company, and the equity holder is a director, and her family trust is the sole shareholder. So using this example, she receives a salary of $200,000 from the business, and at the end of the year, the company pays a dividend, fully franked, to her family trust, which is $200,000, which is $140,000 franked dividend and $60,000 in franking credits. But for the purposes of this, it's deemed to be $200,000, because that you guys that know about franked dividends know that the 140 cash you get for the dividend is income plus the franking credits is as well. So it's effectively, there's 2 incomes here. There's 200,000 salaries and 200,000 dividends. So looking at the first test, which is proportion of profit received in your hands, you look at the $400,000 being the salary and the grossed up dividend. Now, as Astrid receives $200,000, that is actually 50%. So therefore, she would pass the 50% profit test because 50% of that has been returned in her hands, which means that test she would pass the transitional rules, but in the new rules, it would be a 4, okay? Now, the trust decides to distribute 75% of the dividend, which is 150 grand to her spouse, and 25% to a related company, which I would call a bucket company, which is $50,000. So if we're looking at the effective tax rate, what we look at is on the $200,000 salary, Astrid pays tax of $60,667. Her spouse pays tax of $45,667 on the $150,000 grossed up dividend, which is the franked amount and the franking credits. And then the bucket company pays tax of $13,000 on the $50,000 received. When you add the $60,667, the $45,667 and the 13, and divide that by the $400,000, you get an effective tax rate of 28.56, which puts it in a category 4. So the 4 plus 4 would equal the 8. So in my example, that would be a moderate risk, so it's not high risk under the new rules. And if you don't pass test 1 under the transitional rules, test 2 you'd be slightly under the 30% that you need. So it means you'd have to somehow work it out to get that up to, if you don't pass test 1 under the transitional rules, you'd have to pass test 2, which means you'd have to try and work out a way to get your effective tax rate up to 30%. Okay. The next example, I won't go through it. It's a very similar example. I'll leave it up there again, which you can look at your own leisure, and that leads to a lower risk rating in the new rules. I want to go through a trust example. So in this example, you're running your business through a discretionary trust. Unit trust, sorry. Unit trust. Sorry, I said that wrong. Unit trust. And the units for the unit trust are held by a discretionary trust. Now, in this example, Ben would get a $300,000, there's no salary drawn by Ben in this example. What happens is the profit the unit trust makes is $600,000. So in this example, there's no salary drawn by Ben. All that it is the profit entitlement for the whole business, the whole unit trust, is $600,000. And so what happens is $300,000 goes to Ben, $100,000 goes to Ben's wife, and $200,000 to a corporate beneficiary or a bucket company. So in this example, using test 1, because he gets half of the profit distribution available, he passes the 50% thing, so a 4. Ben would pay $105,667 on his $300,000. His wife pays $22,967 on her 100, and the bucket company pays $52,000 on the 200. If you add that all up together and divide it by 600, it's an effective tax rate of 30.11. So under the new rules, that would be a 3, which means it's a total of a 7. That's under the new rules, or which would be low risk, or you've got to pass one of test 1 or 2 in my example, which he would pass both of those in this example, and therefore would be fine. I'm not going to go through that. That's way too complex. So, my summary is, in the majority of businesses, for the majority of businesses, the suspended guidelines are going to be better than the new PCG, and therefore, for 22, 23 and 24 financial years, you need to pass one of these 3 tests, which is the arm's length remuneration test, the 50% share of profit test, and the 30% effective tax rate test. In my experience with the one-on-ones I'm having with businesses right now, is I can't think of anyone who hasn't met one of those. Some of them meet more, but you only need to meet one. And therefore they can income split for 22, 23 and 24 financial years. And obviously that means from 1 July 24 for the 2025 financial year, the new rules will come into play, which is why I went through those case studies. And it's really important to get your head around this stuff. It's not insurmountable, but there might be some planning required. So, e.g., majority of people will pass one of these. So that means there's no real dramas for most people that I'm working with, or that we're working with, for 22, 23 and 24 financial years. But 25 onwards might be a different story. And there may be some planning required between now and then to try and meet the rules. But I'm also saying don't over panic, don't overthink. Things can change so much in 3 years. I think we just focus on making sure we do what we can within the current rules. Anyone that wants a copy of this PowerPoint presentation, and I know there's probably some stuff in there you don't need, but there will be some stuff in there that is valuable to refer back to, and you can do at your leisure. Please email customercare@superioraccountinggroup.com or contact us on 0397878906, and we'll shoot you a copy of the PowerPoint. I went really quickly, and it is heavy, but I know it's late at night, and I know you guys are working hard and probably quite mentally and physically drained, which is why hence why I've gone quickly. Does anyone have any questions about what I've covered before I let you guys go back to your families? I'll pause for a second just in case. If you do, jot it in the Q&A box, guys, and I'll do my best to answer it. I'll give everyone a minute. All right, there's no questions, and I know it's late and everyone's probably tired. Let me just say a couple of things. One, thank you very much for giving up your valuable time in your private time of an evening. I very much appreciate it. I know it's heavy, but this knowledge is super important that you guys get it and understand it, because yes, your accountant should be speaking to you one-on-one about this to make sure you understand the rules and to make sure you comply with the rules. Don't just rely on them. Make sure that you're comfortable and confident that you are meeting these guidelines, because ultimately the buck stops with you and any ramifications will flow to you, even if your advisor has not spoken to you about it or not fully explained these rules. I think it's on you guys to make sure you fully get it and get your head around it and have any questions answered, and make sure that at least in the next 3 years you're taking the action, you're doing everything you need to be able to income split as tax effectively as possible. So please make sure, if you haven't heard, that you reach out to your advisor. And although I would personally be asking why you haven't heard, because you do need to know these rules. I think it's really important with a practical and proactive advisor that you do have this stuff explained to you, and you have a one-on-one consultation with them so that you fully can apply this and get your head around it all. So otherwise, thank you very much for your time, everyone. I appreciate it, and I hope you guys are all doing well in your businesses now post-COVID. Aside from having some illnesses and sicknesses with yourselves and staff, which I think is still a problem. Hopefully you guys are getting back to pre-COVID levels and kicking some goals, and I hope you guys are. And if we can help you at all in any way in the future, please don't hesitate to reach out. And thank you all, and good night.